make like an insane price prediction right now on Bitcoin? What? Why not? We're at 107 likes. We're at 107 likes before we go to commercial. If we jump to 150 likes, I'll tell you what I think is going to happen later this year.
One eternity later.
Done.
Let's hear it.
Let's hear it.
I've been trying not to do this. In 2019, I wrote a piece that said Bitcoin was going to hit 100K. I've never waffled, and when it fell, I just bought more. There's very low chance in my mind we don't hit 100K this year.
So where would you set a target for year end this year and 5 years out?
Great question. Eventually.
But I think, 5 years out, if Bitcoin's not at 500,000, I'm wrong on the adoption cycle.
All right, Chamath, we don't have that much time left. Let's talk rocket ships. First, Bitcoin. That falls into that category because that's what that is. 39,000. Where's it going?
I mean, can you play the clip in 2012 and 13 when it was at 200 and everybody was laughing at me on CNBC every time I would talk about Bitcoin? Where is it going? It's probably going to 100, then 150, then 200,000.
That's why that makes sense, and that means that the top is more than 100 million. More than 100 trillion. It's somewhere between 100 trillion, 300 trillion in today's money.
Hot week for Bitcoin. Tom, you still think it hits 100,000 year end?
Yes.
Well, it's in the penalty box once again here in Fun Straps. Tom Lee is back with us. Tom, do you still think that it can get up to 100,000 this year?
Yes.
Are you still predicting 100,000 Bitcoin by the end of the year, or where is it? Or 100 million? Because I'm talking to Thomas Lee, so you never know.
Yeah. I think Bitcoin can. It's roughly 45,000 today. I think it could easily get to 100,000 before year end.
Bitcoin, I mean, you at one point, I think back in April, told Dow Jones that it could go to about $500,000. Do you still hold that target? Do you still think that's where we're headed?
We do. I do. Yassine El-Mandra is our crypto analyst, and we go through soul-searching times like this and scrape the models. And yes, our conviction is as high.
Fortune favors the brave.
Bruh.
All right. Today is Thursday, the 12th of May. And this is a recap for the stock market activities today. Folks, I got a good one for you tonight. And we're almost done with the week, folks. One more day. One more pie in the face. You know what I'm talking about? Because, you bought the dip, didn't you? They sucked you in the morning, didn't they? GameStop to the moon, AMC to the moon, Bed Bath and Toilet, whatever in the moon. And then you wake up tomorrow and you get a nice pie in the face, they flush the market down, and have a great weekend, goodbye. No, I'm just kidding. I actually have some good news for you. I think somebody capitulated, and it could, keyword could, be a sign for a bottom for now. And therefore, I covered my Qs short, the NASDAQ short. I'm going to talk about it in the charts analysis. And this is a fresh one. This is a new one that I placed last week. We talked on Thursday and we said this is the support line. If it's broken, you got to go short. You know the deal. But now we're going to talk about which signals and moves in the stock market that maybe signaled that it is time to cover and perhaps go long. I covered, but I did not go long. I'm waiting for confirmation. So this is the good news. But let's start with the bad news, because I got plenty of that for you. And here it is, in focus tonight. Ghosts of 2000. Yep, the dot-com bubble implosion. They say history doesn't repeat itself, it often rhymes or whatever. I don't even know what that saying goes, but I say, who cares? History actually repeats itself. You know why? Because human stupidity never changes. It's the same. It's the same dumbass moves that man made back in the cave. And after millions of years, we're still doing the same mistakes again. So yeah. But here it is. Look at this. The valuations, the spread in sales multiples, the dot-com bubble back in the 90s versus the cocaine bubble that we have right now. And look at that. The valuations are going down, indicating that the party is over and we have more pain to come. Here's another valuation metrics for you, the best PE ratio. And again, we got pretty much exactly the same valuations from back in the dot-com bubble, and now we're moving down again. So that tells us that the party's over, and by now, everybody knows that the party's over. But back then, go back a year ago in this channel, I presented you with the same valuation metric, and I said, watch out here, we could be topping, the party could be over, because we got to the same extremes that we got to back in the dot-com bubble of 1999. And there is a lot of pain in the market right now. For example, the Russell 2000 small caps. Well, the relative performance of small caps versus the S&P 500 is the worst in many, many years. Now, when you have a healthy economy and a healthy stock market, the gains should be led by small caps. This is not what we're seeing right now. We're seeing small caps underperforming. And that is always a bad sign. And if the 1999 analogy is not good enough for you, how about 1929? Because we could end up just like that. You get the crash of the dot-com bubble, and then you get the Great Depression from the 1920s. Sounds like a good deal, right? You get 2 for 1. But here it is, Dr. Chiller's CAPE index. Well, the valuations, according to this metric, is pretty much at the eve of the 1929 crash. And a lot of folks are getting creamed out there. Look no further than Mama Cathie Wood, Tesla witch Cathie Wood, who's getting crushed by the day, to the point where I actually feel bad for Mama Cathie. Give the lady a little break here, a little rebound rally, so she can buy the dip again and catch more falling knives. Because back on May 6th, which is ancient history by now, because things moved so quickly since then. But Mama Cathie bought Shopify, Coinbase, and some other shit. And fast forward, here it is. Coinbase was down over 25% yesterday alone. And it's down 50% or more in the course of 5 days. Yep, we got a rebound today, but that's gonna last what? Couple of days, weeks, and then what? We go down again. It's over, folks. Mama Cathie got hit by Palantir, Upstart, and Unity Software, and it keeps going on. No break at all. And the tumble in Coinbase has pushed the RKKKK fund closer to pandemic low. And of course, Mama Cathie's down 76% from the top. But rest assured, she says that her stocks are in deep value territory. And of course, we all know that bankruptcy is the ultimate deep value. Anyways, Cathie Wood is not deterred at all. Today, she snapped up another $3 million worth of Coinbase shares. She's buying the dip. Mama Cathie, she got faith. She believes that God is going to fix everything, and RKK is going to go back to the moon. All-time highs again. And the question is Mama Cathie catching a falling knife? Yes. How about that? Or is she smart as a wit? How about no? And of course, Mama Cathie dumped Tesla $12.7 million worth of Tesla shares, and she bought GM. So the next move is shorting GM. And of course, all of this was predictable, by the way. I produced a video right at the time of Coinbase IPO, and I said, this is a trap, leave it alone, don't touch it, it's toxic waste. And of course, back then, everybody said, what do you know? You're a boomer, you're just jealous, bro. You would have said the same thing about the internet. Okay. Anyways, Coinbase seems like in a lot of trouble right now. Matter of fact, they said that they are aware that customers are having issues trading and accessing accounts on Coinbase. So all of a sudden, if you're launching your Tulip app and you're checking your Tulip wallet and there was no money in there, well, sorry, Coinbase is facing some difficulties right now. And some of those difficulties might involve bankruptcy, which remember, that's deep value. Coinbase says there is no risk of bankruptcy here, folks. We're not burning. Just calm down, please. Nothing to see here. But they also sent you a little booklet, little piece of information of what a bankruptcy would mean to your Tulip portfolio. So yeah, rest assured, no bankruptcy for now, but if it happens, just know that you're gonna lose everything. And speaking of losing everything, look at this. This is not an error, by the way, not a chart that I made on Photoshop. This is a chart of a tulip called, what was it, Luna? Luna? For lunatics kind of token? Well, they call them stable coins, and this is as stable as they can get. Down 99.9% from the top. Not a big deal. But look at that. You went down to 0. I mean, you look at the bright side, you can tattoo this chart in your arm, and you tell the story of how stupid Grandpa was back in the day. Started at the bottom, and now we're back at the bottom. Because as the Romans would say, bag holding favors the brave. But the good news is you're not the only one losing money right now. All the tulip pumpers, they're also in a world of pain. But here's the catch. Before I start reading the information for you, I produced a video not so long ago, and I'm highlighting it for you right here. Make sure that you take your blood pressure medications before watching this video, because when you do, you realize that this is the biggest Ponzi scheme in human history. The insiders, be it in cryptos or stocks, they all dumped right at the top, and they're leaving us, the dummies, holding the bags. But they also happen to hold some bags too. So here it is. Coinbase founder Brian Armstrong had a personal fortune of $13.7 billion as recently as November, and about $8 billion at the end of March. That is now just $2.2 billion, according to the Bloomberg Billionaire Index. Poor guy. How is he going to live? After a sell-off in digital currencies from Bitcoin to Ether triggered a precipitous decline in the market value of Coinbase, the largest U.S. cryptocurrency exchange. Then there is Michael Novogratz, the CEO of crypto merchant bank Galaxy Digital, has seen his fortune plummet to $2.5 billion from $8.5 billion in early November. Does he have a GoFundMe account or something? Anyways, he's been a champion of Terra USD, the algorithmic stablecoin that is now at risk of complete collapse amid a breakdown in the price of crypto token in the same ecosystem, Luna. But remember, CNBC, Bloomberg, they continue to interview this guy as some sort of an expert and a revered market participant we all have to listen to. Meanwhile, he doesn't know shit. It's just pump, pump, pump on the dime of others, aka a pyramid scheme. That's what the crypto market really is. No valuations, no utilities, no use at all. It's all about how much money the next guy is willing to pay for. Bitcoin could be at $1 million or it could be at zero. It all depends on the crowd and the sheepies, the FOMO. How much do they want to pay? And at some point, the FOMO and the mania was at the highs. Everybody was stampeding to buy Bitcoin because guys like Novogratz and the likes been saying, oh, Bitcoin's going to go to 1 million, 100 million. And when people stampede to buy Bitcoin or cryptos, all of these bullshit tokens come rocket and the likes, of course, any asset that has more inflows than outflows will go higher, even if it is horse manure. If we're trading horse manure, and by the way, horse manure right now is more precious than gold. But sake of argument, even shit could be worth trillions of dollars if people want to bid on it. But that's a pyramid scheme. When the recruiting stops and there is no new blood to pump it higher, it goes down crashing. Anyways, here's another one, at least on paper. Changpeng Zhao, the CEO closely held Binance, has lost an even larger fortune than Armstrong or Novogratz. He debuted in the Bloomberg Wealth Index in January with a net worth of $96 billion, one of the world's largest. By Wednesday, that had shrunk to $11.6 billion, using the average enterprise value to sales multiples of Coinbase, and who cares anyways. The guy lost a lot of money, but he's still rich as Armstrong is not the only Coinbase billionaire losing money. Co-founder Fred Ehrsam, a former Goldman Sachs Group trader, is currently worth $1.1 billion, down more than 60% this year. Now, do yourself a favor, by the way, and look at how much dumping this guy did last year. He was dumping right off the gate. The moment the IPO happened, this guy been dumping. And he has right now billions of dollars of cash. And he's been buying properties and scooping other assets, so who cares if his paper money went down 60%? Nobody cares. This is the racket, by the way, that we call the economy and the stock market. And here's another one, Sam Bankman-Fried, who I like, by the way. It seems like he's a decent guy. But that doesn't matter because he's down big. And he lost half of his entire net worth. And rumor has it that Mr. Fried, Bankman, whatever his name is, was planning on getting a haircut, but now he cannot afford it. So yeah, that afro is going to go larger and larger and larger. But he has some pocket change to buy Robinhood. Yep, Bankman-Fried bought a 7.6% stake in Robinhood. Why would you do that now? You got a crypto exchange, you're selling your own tulips. Why would you buy Robinhood? Why would you bet on a dead horse? Because that's what Robinhood is. Robinhood is on the verge of bankruptcy right now. Why would you buy a stake in a company like this? But anyhow, what do I know, right? He's the billionaire. He knows better than me. Maybe he has plans for the company. And here's a life lesson, folks. Don't trust celebrities to buy anything or to guide your investment decisions because they're getting paid to pump. For example, remember that commercial with Matt Damon, Fortune favors the brave or whatever? He says, the Romans says fortune favors the brave. First of all, I wouldn't be quoting the Romans because we all know how that story ended. But anyways, if you listen to Matt Damon, you went down big because back then Bitcoin was at 61,465. Now it's down to 29,579. Not bad, right? And again, rumor has it, Matt Damon, we talked to him and he said, you want to stand apart from the rest? Buy some cryptos. I don't know what the cryptos are, but hey, fortune favors the brave. And if you've been part of the brave, you're down 99% on your Luna and other tokens, tulips, whatever the hell they are. But the massacre is not limited to cryptos. It's all over the place. Have you checked the Jim Cramer Investment Club lately? Well, here it is. It's the best and fastest way to become homeless. And the pain is not going to stop anytime soon, folks, at least according to the folks from Data Trick, who say that the stock market could go down another 25% if job growth slows and the economic recession materializes. Well, we know that the job growth is going to slow because you have companies freezing hiring right now. That is step number one. Step number two, they're going to give you the pink slip and say goodbye, via Zoom, of course. And this will lead to a recession, so yeah, it's going to go another 25%. That's in the bag, but that doesn't mean it's going to happen in one straight shot. We're going to have rebounds, or we might be close to another nice rebound. But before I give you the good news, here's more bad news for you. We have T.S. Lombard, who says the stock market carnage will continue as the Fed hikes while China slows, and there is nowhere to hide. And this is the moment where I actually envy Mitch McConnell because at least he has a turtle shell that he can hide back into. Not in the stock market, though. Not available. And Morgan Stanley says that the sell-off in stocks is not over yet. You know what that means? It is over. Anyways, here's market legend. I don't know if you heard about this guy before or not, but he's been trading stocks since Lincoln was president. And he says he lived through every bear market since the 1950s, and he says the one coming could hit the S&P 500 with a 30% loss. So buckle up your seatbelts. And the damage is clear, by the way, because the most valuable company, no, it's not Apple. Apple is down, and here comes Aramco at number one. And this is a sign of the time that we're living in. Oil shooting up higher, the rest in the trash. And here's some more bad news for you. Are you living paycheck to paycheck? Well, if you are, you're not alone. You're one of 2/3 of Americans who are living paycheck to paycheck right now. 2/3, yep. So we got what, 300 million? So that's 200 million living paycheck to paycheck. And the other 1/3, the other 100 million, they're doing OnlyFans, so they're good. They're not living paycheck to paycheck. So if you don't like it, go pimp yourself out. And of course, Papa Jerome Powell, the big dog, who's been a disaster, the captain of the Titanic, well, he came out clean today and admitted that the Fed should have raised interest rates a little sooner. So he says a little sooner right now. Give him a couple of weeks and he'll say a lot sooner. And Powell now admits that the soft landing or the softish landing, not gonna happen. We're gonna nosedive. Buckle up your seatbelts, close your eyes, and let's all scream in 3, 2, 1. Because Captain Jerome Powell is going to land the plane and he's going to take you to the afterlife. That's the destination. And the market, by the way, already knows that. The market says there is no soft landing, not going to happen. Matter of fact, get ready for a crash. Not just on the plane where the soft landing is supposed to happen, but also in the stock market and the economy. So yep, nowhere to hide. But that's the bad news. Let's get to the good news. Here's the good news. You know, the Wall Streeters and the likes with the FUD, they say don't buy. Stocks are going to go another 25%, 30%. What do they know? They know nothing. We're the experts. We're the captain of the ship now. And guess what? Us, mom and pops, retail, we're buying the dip again. Bank of America says we're seeing more buying of the dip from the retail and the institutionals. The institutionals are buying what? They're buying value, for example. Look at value. Cheap stocks, value, outperforming expensive stocks by a lot. And yes, by outperforming, we don't mean that value is in the moon right now. But look at the contrast. On your left-hand side, in red, U.S. value. In black, Europe value. Not shooting to the moon, but stable for now. You look on your right-hand side, that is U.S. expensive portfolio, and Europe expensive portfolio in black. They're dropping like a rock. So value for now, outperforming growth. On top of that, we have consumer staples. Well, for years, consumer staples have been underperforming the S&P 500. Right now, we're seeing a phenomenon where consumer staples actually outperforming the S&P 500. And consumer staples have a lot of ground to cover here if this outperformance lasts. So is the retail crowd buying the dip in staples or energy or value? Of course not. So what did they buy the dip in? Here it is. How about GameStop? GameStop jumps more than 20% in odd trading. AMC shares also pop. So the same stupidity over and over and over and over again. They also bought Carvana. Carvana is down big. I mean, we're going to see a short covering rally. We're going to see oversold rallies. Just look at your charting program. You're going to see a lot of charts in these beaten down names that are really, really oversold in the RSI. They're gonna bounce, but the bounces are not gonna last. So trade them, don't invest in them. And here's the concluding thought. Today I said this, there is some short covering happening in the most beaten down stocks, like Carvana, like the GameStops of the world, like the MicroStrategies of the world, like the RKKs of the world. The question becomes, what happens to all of these profits if the shorts are going to cover and perhaps place a trap for the retail crowd to buy the dip? Where will that money rotate to? Because we're seeing another phenomenon, which is the sell-off in the big caps, specifically Apple. So we're seeing a lot of cash being raised. Where will that cash go? From the shorts, booking profits in the RKKs of the world, the Shopifys of the world, the Etsy's of the world. And by the way, I did cover my short in Etsy today, and I did take profits from the names in my long portfolio that ran too high. So I'm raising a lot of cash. And market participants are also raising a lot of cash from covering their shorts and dumping Apple, Microsoft, the big caps. So where will the cash go? Because the answer to that question will dictate what happens next. Now, would the answer be buying the meme stocks and RKK once again? Why would you do that? You just covered your short. Why would you buy these names? Doesn't make sense at all. Sure, the retail crowd could be sucked in these short covering rallies and buy the dip and make them last for a little while. But the main question is, besides the distractions, where will the cash go? We will know the answer to that question in the next few days, in the next few weeks. There will be highly critical. So let me know in the comments, where do you think this cash will go? But here's the concluding thought for now. Look at these boxes in yellow. These are the sectors of the map, the stock market map, in general, of course, that move based on the move in the 10-year yield. Today, the 10-year yield was down, and therefore we're seeing activities, green activities, in cyclicals, in communication services, in software, for example, the high beta names. But a drop in yields is not good for financials, and therefore we're seeing banks dropping down, the credit card companies dropping down. But there is another side of the stock market that is dictated via the US dollar. Here it is in white. These are materials, energy, and defensives. The dollar doesn't want to give up at all. So we're seeing weakness in metals. We're seeing weakness in energy and defensives. So again, for a wholesome rally to happen in the stock market, we know what the ingredients are. Ingredient number one is short covering. Well, we're seeing that happening today. Is it going to last or not last? That's a different story. Ingredient number two is retail participation. And we can detect that via two things. Number one, an increase in call options volume. We have yet to see that happen, but also a stampede in buying meme stocks and the likes. The retail crowd favorite names. We got that today. Whether it's going to last or not, that's a different story. But ingredient number three is a drop in the 10-year yield. Well, we got that today. Is it going to last? Do we have a confirmation? That's a different story. We have to look at the charts. Ingredient number four, and this is the difficult one, the sticky one, is a drop in the US dollar. And if the dollar continues to move higher, we're not going to have a sustained rally here. We're not going to have a wholesome rally in the equities market. So we need four things to happen: short covering, retail participation, a drop in the 10-year yield, and a drop in the US dollar. If these four conditions are met, you buy with both hands, we have a decent rebound rally coming. Absent of that, it's going to continue to be a trap. And with that, folks, let's move on to cover the stock market. And we start with the performance of indices today. And here we go. It was another roller coaster day in the stock market today. The Dow Industrial Average went up and down, up and down, up and down. And at last, it finished down by 103.81 points, or a decline of 0.33%. The Nasdaq, it went up and down, up and down, up and down, and finished flat, up by 6.73 points, or a gain of 0.06%. S&P 500, similar story here, with the roller coaster ride, but it finished down very flattish, down 5.10 points, or a decline of 0.13%. The sector's performances led by healthcare, number one, capturing the gold medal, and number two for the silver cyclicals, and number three for the bronze REITs. On the other hand, the laggards led by materials, utilities, and financials. The advance, the decline ratio, lots of improvement today, at least on face value. The NYSE 57% advancing versus 41% declining. The Nasdaq 56% advancing versus 40% declining. But again, the devil is always in the details. And we have another 1,092 52-week lows in the Nasdaq versus only a pathetic 6 new 52 weeks highs. If this is not a bear market, I don't know what it is. Moving on to commodities, mixed. The dollar is up. So was the Japanese yen, by the way. But the weakness in the Australian dollar and the euro is impacting metals badly. And it should impact oil badly. But the resiliency of the tailwinds in oil is keeping oil afloat. The moment the dollar goes down, watch out for the explosive rally in oil. For now, the WTI closing with gains of almost 1% today. Brent pretty much flat with modest gains. And then we have gasoline, here we go, gaining another 3% today alone. And now we're closing at 3.8 in the futures, which means at the pump you're going to pay 5+, because this is the entry cost, there is the refining cost, there is the transportation cost, and there is, of course, the markup that these gas stations have to add to make profits. But of course, your beloved leaders, senile leaders, have no clue. And now Pelosi says she has a bill that she's going to present to the floor next week to prevent price gouging in the oil industry. And I'm issuing a challenge here to Mrs. Pelosi in this program. If you go back to school and take economics classes, I will pay for them. Here we go. I'm volunteering. I'll pay for Nancy Pelosi's classes in exchange, of course, of some options tip for Mrs. Pelosi. But anyways, we have flattish activities for heating oil and natural gas. Nothing moving here, although the majority of the action in natural gas is across the Atlantic in Europe because Ukraine is shutting some Russian gas flow to the European continent, and this is pushing prices higher. Today, we got rumors that the Russians themselves are cutting some gas flows to Germany as retaliation for not paying in rubles, even though we're getting more and more capitulation by European gas companies. And now Draghi in Italy, well, he's allowing companies to pay for Russian gas by using rubles. What is the point of the sanctions again? Anyways, here is softs. Coffee is giving up some of the gains from yesterday, down about 2%. Likewise, we have cocoa down almost 2.5%. Lumber down modestly, a little over half a percentage point. And then we have modest gains for both OJ and sugar, and cotton is the winner of the day in softs, closing the day with gains of a little over 1%. When it comes to metals, a massacre across the board. Gold down, silver down, platinum down, copper down, palladium down big. We're talking about massive losses here for palladium, platinum, silver down over 4%. And the reason is the dollar cannot stop moving higher. So what do you do now? Do you fight it? Do you continue to hold on to your gold miners and other metals producers? Perhaps, or do you get rid of them? Well, here's the thing in my thinking. The moment I dump my gold miners, for example, that would be the moment where the dollar tops and drops down, and we see a massive rally in gold, for example. And therefore, I'm not going to do it. One of you guys should do it, and then metals are going to rally higher. You know who you are. If you have that kind of luck, let me know in the comments. But here it is, when we talk about meats down across the board, lean hogs getting slaughtered today, down, about 3.5%. Feeder cattle down over 2%. Live cattle futures also down a little over 1%. When it comes to grains, the rally in wheat, no stop in sight here, up over 5% today alone. Likewise, oat is rebounding higher and gaining a little over 3%. We have modest gains for corn and soybeans futures, and then we have rough rice pretty much in the flat line, where we have down days for canola, down over 2%, soybean oil down a little over 1%, and then soybean meal down modestly, pretty much in the flat line. Moving on, the big casino, the options market, what's going on here? Are we seeing the volume ramping up? Yes. Not by a lot, but yes, they're buying more calls. And most notably, the majority of the action is actually in Apple. The name happens to be the hottest table by far in the casino today, by over 2 million contracts traded today. About 53% of those were calls. And here it is, the retail participation is back. AMC at number 2, with around 730,000 contracts. About 68% of those were calls. What does that mean? The name used to trade 200,000 contracts, 100,000 contracts. Today, we moved to over 700,000 contracts. That tells me there is retail participation. Is it a trap? Is it not a trap? That's a different story. We know that the short covering initiated the retail participation because they saw AMC moving higher. Hey, why not buy calls and see what happens? And they bought a lot of calls today, which will support a rally in AMC at least for a few days because the market maker has to buy the shares now to hedge, and that will push AMC higher. We're getting to options expiration. A lot of the shorts who did not cover will start to cover. So this is good news for AMC. The bad news is if it is a trap, if the retail crowd gets in, and then what do you know? They short it again next week or after that, we see more selling. But at number 3, Tesla, the souffle, at around 700,000 contracts, about 51.5% of those were calls. And here are the unusual activities that took place in the options market today. And spoiler alert, it was all Apple pretty much. Lots of Apple. The majority of these big, massive trades were for puts. Now, you could say that this is hedging, and it could be a contrarian indicator that Apple is bottoming, and if Apple is bottoming, the NASDAQ is bottoming. That's a thought. It's a legit thought. It's a valid thought. Maybe the Johnny-come-latelys are showing up right now, buying puts, hedging right now, and that could be a sign of a bottom. I get all of that, but we've seen these kind of moves in other stocks before. We thought it's the Johnny-come-latelys, it is a sign for a bottom. It did not happen. But remember this, in the previous instances where we thought it could be a bottom, we did not have the 4 ingredients for a bottom. We did not see short covering. We did not see retail participation in the options market. We did not see the dollar moving down. We did not see the 10-year yield moving down in a significant way. What's different this time around is we have at least 3 ingredients with 1 missing. So yes, it could be a sign for a bottom in Apple, at least for now. But regardless, they bought the 135 puts for the expiration date, May 20th, with expectations that the name could move higher by more than 5% by then. And again, keep in mind, this is a short-term trade with 8 days till expiration. So it is not significant from a prediction aspect. Yet it is significant from a value aspect because they paid around $1.65 a piece to enter this trade, all in all spending around $13 million. And here it is, GM, General Motors. Mama Kathy's buying and somebody's betting that she's going to be right this time around by buying the 42 calls for the expiration date, June 17th, with the expectations that the name could move higher by more than 18% by then. They paid around 45 cents a piece to enter this trade, all in all spending around $1.3 million. And to be fair, here's the call options trade for Apple. They're buying the 150 calls for the expiration date, June 17th, with expectations that the name could move higher by more than 5% by then. They paid around $4.20 a piece to enter this trade, all in all spending around $5.5 million. Continuing with interesting trades, what about the trade for the ticker TSLA, the souffle, Tesla? They're buying the 800 calls for the expiration date next Friday, May 20th, with expectations that the name could rebound by more than 10% by then. They paid around $11.50 a piece to enter this trade, all in all spending around $11.5 million. So again, we have somebody bidding $13 million against Apple, and then we have somebody betting $11.5 million for Tesla. Conflicting, confusing, but these are the signs that things are changing. The tide is changing. For example, here's another one, NVDA. We have both a put and a call trade. Let's start with the put. They're buying the 150 puts for the expiration date next Friday, May 20th, with expectations that Nvidia could move down by more than 7% by then. They paid around $3.70 a piece to enter this trade, all in all spending around $3 million. And lastly, at the bottom of the table, again, NVDA and Nvidia. This time around, they bought calls, the 170 calls for the expiration date, once again, May 20th, next Friday, with expectations that the name could move higher by more than 5% by then. They paid around $4.50 a piece to enter this trade, all in all spending around $3 million. Moving on to the heat map analysis, what's going on here? The alarming sign is the fact that the big caps are getting hit. In this case, Apple, Microsoft, Nvidia. The good sign is we're seeing short covering in the software names, the most beaten down names, biotech, the communication services now, the likes of Netflix, for example. The short covering was obvious today. So what are they thinking here? They're dumping financials, they're dumping utilities, they got back in REITs modestly today, but they're dumping materials, gold, copper, steel, all down today. The dollar is moving higher. Energy not moving by a lot, mostly to the downside. So what's going on here? Is it a one-day wonder when we saw some short covering and then a resumption, the same theme of selling, perhaps? What's up with the sell-off in Apple, for example? Because that's the sticky part. The end result by the short covering and dumping Apple is raising cash. So are investors and traders just raising cash for now, waiting on the sidelines? If that is the case, then we're not going to see more follow-up to the moves that we got today. But if the money's about to rotate somewhere in this map, we'd like to know where. right? So we can buy ahead of time. For now, we don't have a lot of clues. You cannot assume that the short covering of software, for example, is sustainable without a confirmation, without a recapture of key support levels. Is it healthcare, for example, the winner of the day? Are they moving back to healthcare? Where in healthcare? Because the big pharma names have been outperforming for a while now. They pay a lot of dividend. They're stable for now. So here's the thing, folks. I'm not going to read too much into it for now because the action that we got today is all over the place. For example, when we look at the so-called reopening, for example, you have apparel moving higher. You have leisure moving higher. You have some of the casinos moving higher. Yet airlines got absolutely creamed today. So we have mixed messages. It's not just the contrast between software and Apple, for example. It's all over the place. Blackstone was up, the rest of the asset management was down. Certain names in materials moved higher, but the rest were down. And it goes on and on and on. Even in automotives, for example, General Motor, Ford down, but the electric vehicles, Rivian, Lucid, Neo moved higher. So we have all of these divergences all over the place. You cannot make a decision on the action that we got today alone. You can do some short covering if you're up big. Remember, in this market, you always have to be closing. When you make profits, big profits, short amount of time, why not take the profits when you have signs of perhaps we're getting into a bottom? And this is what I did today. We'll talk in a minute in the charts analysis. But before we do that, here it is. The daily heat map for the ETFs, again, muted across the board. And this gives us more clarity, by the way, than the previous map because even though the software names were trading higher, value outperformed growth, not by a lot. Both were pretty much in the flat line. And the majority of the losses that happened today came from metals, silver, gold. The commodities names were down. Not energy, though. Energy is stable for now. Yet the gains came from the XBI, a rebound from biotech, XHB, XRT. Why would the XHB, for example, home builders, trade higher today? The answer is the drop in the 10-year yield. Can you have a confirmation on that? Of course not. Not yet, at least. So we have signs that the 10-year is topping the action of the XRT and the XHB, but it could be premature without looking at the charts. So let's do that and move on to the charts analysis, and we start with the SPY, the S&P 500, and this is a 30 minutes chart. Again, we are in no man's land. What does that mean? There is no solid support in this chart at all. It is in a free fall until we have a reversal. This reversal could happen via short covering. It always starts this way. So is this the beginning of short covering that will be followed up by retail participation and more buying of the dip, and then a drop in the 10-year yield and a drop in the Dixie, and then higher we go above the last support that we lost, 405, even higher? Why not 410.5? 416. All of these targets could happen if we have all four ingredients, but most importantly, they have to be sustainable. We cannot have 1 day of short covering and assume that it's going to last because we've been fooled before. For example, we all remember last time around, 2 weeks ago, we got the short covering. That was a pie in the face. It did not last more than 1 day. Then we got the post-Powell conference short covering. That was another pie in the face. So could third time be a charm? You'll know once we get above 405 and you have the four ingredients intact. Here is the daily chart for the SPY's continuous contract. And again, the good news is we have a rebound pretty much to the penny from 3,850. And it appears for now that the chart, if it continues to have the momentum of short covering and retail participation, it could get us above 3,960 once again. If that happens by the end of the week, that would be a win for the bulls because at least they became successful in stopping the bleeding. And for now, stopping the bleeding is a win. Now, if we see a gap and crap in the morning right away and this chart breaches 3,850, then the bears are going to double down again and I will open shorts once again. So you have your numbers above 3,960, the bulls win, and perhaps we will see a continuation of the short covering in the upcoming week. A closing below 3,850 will initiate a double down in the short by bears. Here's the SPX, the cash index, and again, I'm looking at one important number, and that number is 4,000. Can the bulls get us above 4,000 by the end of the week? If that happens, it will be a massive win for the bulls. But not to spoil the party or anything, whatever rebound we get after climbing 4,000 will be short-lived. You know why? Because in charting behavior, when you break below important numbers like 4,000 and then you climb them back like nothing happened, it is usually a trap it is usually sooner or later the same number, 4,000, will be broken again to the downside. This is the first peak below 4,000, and of course, that will elicit a response by the algos, by the institutionals, by the shorts to keep this number alive, because a closing below 4,000 is a defeat for the entire financial management industry. If we have a closing below 4,000, just like that, then we have a key indicator that the worst is yet to come. So of course it is in the interest of the financial firms to close this chart above 4,000 by the end of the week. And they will do whatever they need to do to achieve this goal. If it means covering some of their shorts, they would do that, because losing this number is a massive psychological defeat for the bulls. And here is the Qs, a 30-minute chart. Again, it was another roller coaster day, because in the morning we thought we're going higher. Then the chart went down again, retesting the bottom. Yet at the end of the day, we saw the short covering and a rebound from the same bottom. So are we looking at a double bottom formation that should take us above 297 perhaps by the end of the week? If that happens, it will be a major victory for the bulls, because again, they stopped the bleeding. And that is important in this game. Here's the daily chart for the continuous contract for the Qs, the Nasdaq. Again, it is not the most oversold that we've seen before. It could get even more oversold if it wants to, but the key number becomes 12,207. A closing above that number will at least give the bulls the time over the weekend to think and reassess, perhaps look at different charts, maybe oversold charts on the daily, maybe certain stocks that went down too much, and they start picking up on those. It will also give the bears the time to think over the weekend that, hey, you made a lot of profits here, and the bulls fought back on Thursday and Friday and closed the chart above 12,207. Why not book your profits before you get caught in a short covering rally? And that could intensify the move next week to the upside, of course. And therefore, last week, same time last week, I said if the chart breaks 12,766 as support, you gotta go short. Okay, we went short. That produced a massive amount of gains quickly because it's done via put options. Am I gonna hold on these puts forever, assuming that the chart is going to go down in a straight line? Of course not. In this environment, in the stock market, always be closing. And after the signs that I got today from certain retail participation, a down day in the 10-year yield, some short covering in the most beaten down names, I'm putting two and two together, and I decided to cover my Qs short. In, out, hello, goodbye, at least for now. You can always get back in the trade anytime you want, but you can't always keep your profits. Anyhow, here's the IWM, a 30-minute chart once again, and we have the resistance right now at 174.22. Just like we talked with the Qs, we got to move higher. It stopped at 174, let's call it 174 for now, and then went down in a retest the same bottom earlier in the morning, and it rebounded higher by the end of the day. It did not recapture 174.22, that would have been a confirmation, but good enough for now to encourage the bulls to participate at least tomorrow, and also to encourage the bears to maybe cover some of your shorts. We'll see what happens. But here it is, the most important chart of the day, of the week, of the year, the dollar index. A massive pop higher today. No wonder why we're seeing metals down big. No wonder why we're seeing any attempt for a rally in the stock market stalling. This guy has to go down before anything happened in the stock market. And so far, we don't have any sign that this is stopping anytime soon. I can do a monthly chart for you. It's going to look scary because the next target is way up there. I'm not going to do that now. I want to see how the dollar behaves tomorrow, for example. If it goes up again, then we're going to look at the monthly chart over the weekend. But here's gold, the daily chart, breaking critical support. If the dollar moves higher again, gold could erase the entire gains year to date. We talked about that before. We talked about once the chart goes below 1,925, you might want to think about booking your profits. I did not, but a lot of you did. Now, I know the moment I book my profits, whatever left of them, from gold miners, for example, that would be the moment where gold is going to bottom and move higher. So I'm not going to do that. I'm going to let one of you guys do that. I mean, think about it. When you do that, the dollar is going to go down, stock market will go higher. You're going to be a hero. So lose some money for the rest of us, please. And here is UK oil, Brent, 4 hours chart. Again, it is moving higher above 105.84. The problem is, can you trust this move higher? Of course not. Technically speaking, the chart has to go above 114, where the double top is in for now, break above 114, and then we're talking. Then we have a massive rally in crude. That would be confirmed, by the way, if the dollar flushes down. So keep your eyes open. For now, I'm not seduced by the fact that crude retested 105.84 and bounced higher. I want to see it above 114. I want to see 114 defeated before I get back in. And here it is, the daily chart for the 10-year yield. We now have a semi-confirmation that we could have a temporary top in the 10-year yield for now. The momentum indicators are stalling. The chart is stalling. Perhaps the confirmation would be, let's say, losing 2.75% as support. That would be a confirmation that, hey, the 10-year yield is cooling off, even if it consolidates from this point on. Even that will be good enough for the Nasdaq to move higher in a rebound rally. But the market doesn't want to seize these impulsive moves higher in this chart. And for now, it appears that at least we're seeing a pullback, a consolidation. Of course, if we have another pop higher overnight, that will negate everything. And therefore, I say the confirmation would be losing 2.75 as support. Now, here's a mystery for you, because while the 10-year yield was down, the TLT was also down. This is a weekly chart, and it appears that the TLT is bottoming for now, but why didn't it go higher today? See, when we talk about confirmations, it's not just losing 2.75, it is also the TLT getting above 125.12. Then we have a confirmation that the bond market is cooling down, and now you got the green light to buy some of the beaten down names in the Nasdaq. As a trade, of course, we're not buying these names to add in the portfolio, because in the long run, the entirety of the market is going down. That doesn't mean it's going to happen without a relief rally that could last for days, if not weeks. With that being said, here it is, the VIX 4 hours chart. What's going on here? The VIX is running out of time. Running out of time to do what? To pop higher if it wants to, because so far it is losing the support of 33. Number one. Number two, it is about to lose the trend line. Number three, it made a lower high. Number four, it is losing momentum on the indicators, the RSI and the MACD. So the VIX is running out of time. Either it pops higher soon, by soon we mean tomorrow, or we're going to see a flush down, a loss of this trend line, and we see the VIX moving down all the way in a retest to, let's say, 25. If that happens, the SPY is going to rally big, and we will see a decent closing for the week. And here is the VXN 4 hours chart. Once again, the momentum remains positive here, unlike the regular VIX, but it is also stalling at around 44.5. It did not lose the support of 40. So again, the tailwinds for the SPY a lot stronger than the Qs until and unless we see the VXN losing 40 as support, and we see a big flush down, losing a lot of momentum. That could happen as soon as tomorrow. That will be a confirmation that this rebound rally is for real. It is legit. We're going to see massive drops in both the VIX and the VXN. Absent of that, it is another trap. Now, here's Apple, and the question is this a bottoming candle? It is a doji candle for now, meaning indecisive, but usually we see tops and bottoms via dojis, and the key is the confirmation. What would the next candle look like? And if the next candle is green, it takes us above 145 by the end of the week. Then we got a confirmation that this is a temporary bottom, at least for now, and it's going to hold on for days, if not weeks. Next, we have Tesla, the souffle, an hourly chart. It went down all the way to 700, and it caught that support, at least for now. The name has been under constant selling for days, if not weeks now. It is getting oversold. If we see the 4 ingredients happening, or at least 3 happening again in tomorrow's session, then we're going to have a confirmation that at least there is something going on here, and Tesla will move higher, and the next resistance will be 802.41. Now, you might ask, what about the bears? What are the bears looking at? The bears are looking for a weekly close under 700, because once the chart loses 700, which is a critical support, by the way, we're going to see another sinkhole opening in Tesla. Moving on to tulips, BTC, here it is. The good news is we have a massive flush down with high volume. That could be the washout moment, and then the buyers step in, and if they do, we could see Bitcoin above 30,000 again, and the resistance, if that happens, becomes 35,750. Again, any rebound is not going to last for too long, but you're going to have to play them one way or the other. And you certainly don't want to be caught short while we have a massive short covering rally, because you're going to see your profits, poof, gone. So number one, if you see a continuation of the move that we got today, for the love of God, cover your shorts, specifically those puts that you have with shorter expiration dates, book your profits, raise some cash, and then if you want to buy this rebound rally, this oversold rally, look at the charts. Look at these oversold names on the RSI from a daily chart perspective. and buy some call options on those. But here's the warning. These oversold rallies don't last for too long. They snap back really fast and then they move down really fast. And by the way, the call options get really expensive also fast. So you gotta make your moves quickly. Don't come to me in Twitter and say, do I buy now? Netflix is already up 20% in 2 days. Do I buy now? Do I buy? Just assess the risk and make your moves. He who hesitates, you know what. Anyhow, we're moving on. We're not doing AMC, by the way, because AMC bounced higher today, but the name in the long run is trash. It broke the important support levels, so it's going to go down to zero sooner or later. That doesn't mean that you shouldn't play these rebounds via call options, so keep that in mind. Now, with that, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the Import Price Index. We also have the most important University of Michigan Consumer Sentiment Index. We also have the Demon from Minneapolis, President Neil Kashkari speaking. We'll see if there is anything valuable to extract from there. Probably not, but anyways. Folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again over the weekend. Take care.